Good afternoon and welcome to the 29th Annual Bender Commercial Real Estate Market Outlook. It's our goal, as always, to bring you, the business community, timely, trusted, and accurate information so that you can make informed decisions on your own portfolio and for those that you advise as we go on in the upcoming year. As I look back into 2025, I felt like we were opening up Forrest Gump's box of chocolates. There was a ton of uncertainty last year. We didn't know what we were going to get. As we go rewind with me 12 to 15 months, we started the year with LA wildfires, Texas flooding. We had 225 executive orders. We had tariffs implementation and Liberation Day. We had Doge. Everybody remember Elon was going to change the world, drain the swamp. He was there for about a minute and a half, realized there's just too much pork in Washington, and he's on to the moon now. And we had Doge and tariffs, and we had assassination attempts with Charlie Kirk, and 2024, late in that year, Brian Thompson as well. We have California that wants to tax its billionaires in a 5% asset seizure tax, and New York City has elected an openly socialist mayor. A lot has changed in the last 12 months. That doesn't even get into all the geopolitical issues. The United States has essentially picked a fight with half the globe. Think about it. Canada and Mexico with tariffs, Greenland for a possible military base, and NATO and the European nations. We have ongoing war with China or with Russia and Ukraine. We have China and Taiwan tension. A lot has changed in the last 12 months. Another thing that's changed, the One Big Beautiful Bill passed around July 4th this year. Two major takeaways here. Number one, bonus depreciation is a big deal in our world. And we know for the next 3 years that's unchanged. It's back. The 2017 Trump tax cuts are back. Bonus depreciation, we have 100% bonus depreciation for the next 3 years. There's no sunset on that, but for the next 3 years, we know that's in control. Number two, qualified opportunity zones are being studied today. They will incentivize development in rural and blighted areas, and those are going to be released later on in 2026. Two big things for the commercial real estate sector. Let's talk about affordability because that is a big issue. The average American right now is getting pummeled. In the last 5 years, groceries are up 30%. Health insurance is up 30%. Property taxes are another issue. Property insurance is up 70%. Daycare is up 30%. The average American is getting pummeled. Hopefully, there's some good news in the underlying economy that'll get us through this. Let's talk about that. Let's take a look at GDP. The last 4 years of GDP coming out of COVID, we had a nice run between 2 and 3% GDP. That number in 2025 is actually a projection. We've got the final number of fourth quarter coming out tomorrow. But the third quarter was a very hot number. We think that there's a ton of productivity gains with artificial intelligence, and we are very bullish on our GDP as we look forward into 2026. I'll save my prediction for the very end. Let's take a look at inflation. The Fed has two jobs, inflation and unemployment. And as you can see, we finished the year last year at 2.7%. 1 year earlier, in December of 2024, we were at 2.9%. Okay, so we were pretty stagnant. Even with the tariffs, we were pretty stagnant last year. Now, last week, there was a soft reading of 2.4 in January. That is a good sign. Something to watch as we continue on with this year. Let's look at unemployment. Okay, the United States unemployment number finished the year at 4.4%. Still very healthy. Technically full employment. It's still a very good job market in the country. In Sioux Falls, we're almost exactly half of that number generally. We beat that by a little bit this year, 2.1%. It's a very tight labor market here still in Sioux Falls. But there are some cautionary undertones that we'll look at in a few slides. So what's the Fed going to do this year? Chairman Powell's term is up in May. Kevin Warsh has been named his successor. It seems like Kevin Warsh is going to be more in lockstep with Trump policy, and I would imagine that we'll see some rate cuts. Currently today, there's a 65% chance of a rate cut by June and an 80% chance of a second rate cut by the end of the year. I'll make my prediction at the very end. I want to point out a couple things. Just because the Fed cuts the short-term overnight rate to the banks doesn't necessarily correlate to our mortgages. As much as I'd like it to, it doesn't necessarily mean that. So I want to take your attention to the last 4 months of 2025. On September 1st of 2025, the 10-year Treasury was trading at about 4.25%. 4 months and 3 rate cuts later, the Fed cut rates in September, October, and December last year. The 10-year Treasury was trading at about 4.2%. It had impact, but very, very little. Let's switch now and look at what's going on in the Sioux Falls market. We start this every year. We look at population growth, and we also look at job growth. No surprise to anybody in here that we had 5,000 people move to Sioux Falls last year, probably closer to 7,000 when you include the metro area, a very strong underlying population growth. However, take a look at the jobs. Sioux Falls added less than 500 net new jobs last year. Take a look at 2009 and 2020, the last 2 drawdowns. I think employers are being cautious. I think there's some productivity that's happening downstream with artificial intelligence. This will be an interesting thing to watch locally and nationally as we go forward. Take a look at building permits. Sioux Falls had an awesome year. $1.3 billion in building permits. Second highest year ever. Very good year. Now look at the gold bar. That's your commercial and multifamily. Almost 80% of our construction last year was on the commercial side and in multifamily. Now take a look at the residential side. 3 years flat. The single family builders are feeling the pinch right now in the underlying economy. All right, let's take a look at those permits one step further. This chart is correlation between Sioux Falls building permits and the outlying communities. Sioux Falls is becoming a metro area, and we've been tracking this. Hartford, Harrisburg, T, and Brandon. As you can see, the dispersion is continuing to tighten between those building permits pulled in Sioux Falls and those in the outlying communities. Watch for this trend to continue. Now let's look at those commercial construction projects again, that $1 billion that we looked at previously. And in this chart, we're looking at the new construction versus addition remodel. In an expanding economy, new construction outpaces addition and remodel. For 10 years running, Sioux Falls, by this chart, is in an expanding economy. There's still a lot of active commercial construction going on in our market. Very, very healthy. How did we compare regionally? Well, Sioux Falls had $1.3 billion in permits. You include the metro, closer to $1.5 billion, about 5,800 per capita. Very healthy year comparatively. Take a look at Rochester. The Mayo Clinic recently announced a $5 billion announcement of healthcare expansion there. Watch for Rochester to continue to put up some points over the next decade. However, also look at their permits, 14,000 permits. Those guys need a permit to mow their lawn over in Minnesota. Take a look at Fargo in contrast. Fargo had a pretty down year. It was a reset year in Fargo. $720 million worth of construction. That was about a 25% reduction over the previous year. Of that 720, only 145 million was on the commercial side. We had 3 projects, individual projects that were more than their commercial number. Fargo had a reset year. If you look at the underlying metrics, though, and throughout all their asset classes, we are nearly the same on vacancy. They just had a reset. I would look for them to pop back next year. All right, some predictions. Let's wrap this up. 10-year Treasury is going to hold pretty firm this year. I think you're going to hang out in the lower 4s. If it drops into the 3s, that would be a good day to pick up your phone, call your banker, and get a rate lock. Okay? I think there's going to be 3 rate cuts from the Fed this year. Again, reminder, those are short-term cuts. Inflation is going to hold pretty steady, but I'm very bullish on the GDP. I think we're going to see a 4% run up in GDP. The underlying metrics, we are poised for a breakout year. And most of that's due to some monetary policy as well as our artificial intelligence and some of the productivity gains that are forthcoming. Sioux Falls construction, I think we're going to take we're going to come back just a little bit, 1.1 to 1.2 billion. However, that could all be thrown out the window if the data center goes, the Gemini data center, or the full prison permit gets pulled this year. That concludes my presentation. I'd like to bring up Braden Nisus and Rob Kurtenbach to present on the land market. Thank you.
All right. Well, thank you, Reggie. Well, my name's Rob Kurtenbach, and this is Braden Nisus, and we are going to present on the land market as well as data centers. So we're going to start out talking about unimproved land. So this is raw land, think farmland on the edge of the city. And this is land that's going to be purchased generally by a developer and put some infrastructure into it. But we're talking about farmland on the edge of the city. For the sake of the conversation today, we're including Sioux Falls, Brandon, Harrisburg, and T areas. Let's take a look at how we did in 2025. So as you can see here on the screen, we had a pretty solid year. In fact, our second best year on record. So it was a great year as far as unimproved land transactions are concerned. Still a pretty far cry from our record year of 2021. Those were the good old days, but still a really solid year with our second best year on record. Two items to note: we had two larger end user transactions included in that. That is the data center on the east side, which we're going to dig into data centers here in a bit, and then also the prison site as well. Let's break those down, or let's move on to the next slide here.
Yeah, as we look at the data, we separate the acres into the growth areas that each community has established. And as you can see, we've been following this trend where the percentage of acres is getting closer and closer to 50% between Sioux Falls and our neighboring communities. Let's take a look at last year. Now, Sioux Falls had a slight recovery. They had a 63% of the acres that were purchased. But as Rob mentioned, we kind of had some outliers where some end users were purchasing raw land. Now, if we take that out of the data and we look at it from what developers are purchasing, Sioux Falls actually falls below 50% at 49%, falling back into that trend that we were seeing. We're seeing this in other data as well. Reggie just mentioned single-family permits, right? That gap closing, as well as in the preliminary plans in the Sioux Falls. Now, this graph represents the approved acres that the city of Sioux Falls has approved for preliminary plans, and that really is just the first step for development from raw land into development. But I don't want to sound all doom and gloom about Sioux Falls because I think there's a couple reasons why this is happening. One, we're truly maturing into a metro area, but more importantly, I think it's investment into infrastructure, creating more opportunities for developers to find land that landowners are willing to sell. Here's an example. In 2020, I presented how the city of Harrisburg was investing in infrastructure, taking it out to Adventure Elementary out by Baker Crossing Golf Course. Now, since then, over 600 acres have been purchased just in this area. And a lion's share of that has been in the last 18 to 24 months. Excuse me. And I truly think that's going to transform Harrisburg for the next 1 to 2 years with the rooftops that are going to go right in that area. But where is Sioux Falls in that? Well, they're at the end of their project out on the west side, out by Cherry Lake. And when that's completed, it's going to open up about 3,000 acres to be served, giving more opportunities to developers to find land within the city of Sioux Falls. Let's take a look at some pricing. Now, overall, there were 11 total transactions, ranging from $26,500 an acre all the way up to $108,000 per acre, that larger one being the prison site that the South Dakota purchased.
A few other sites that I want to point out is the west side. If you notice kind of that true west area on that map, there is no transactions. That's a direct correlation of what Braden just talked about with that sewer expansion coming. So keep an eye on that area over the next several years as we do expect to see several transactions occur there. Also want to mention, related to Braden's comment about the city of Harrisburg, our largest transaction for 25 was 300 acres, purchased for about $35,000 an acre. That's in that Harrisburg city limits. This is a really exciting project. This is the Allura development. at the intersection of Louise Avenue and 271st, which is the T exit. So think about where the roundabout is, that area there. This is going to be the first time the two city limits touch between Sioux Falls and Harrisburg, so it's an exciting development to keep an eye on. Lastly, I want to talk about the data center site on the east side, 165 acres for about $60,000 an acre. Let's dig a little deeper on some data center stuff here. Well, a year ago, we brought up data centers for the first time in our presentation. Nationally, it was getting a little bit of traction, but really nothing too exciting locally had happened quite yet. But wow, what a difference a year can make. If you need to go find out some opinions of that, just go onto your favorite social media accounts, and you can find all sorts of information about what people's thoughts are on data centers. Well, let's focus in on the Gemini data center. That's on the east side of Sioux Falls. That's the one that we've heard a lot about. That has officially gotten annexed into the city limits. It's also got the rezone approved. The only thing really holding that back, or the main thing holding that back from moving forward, is South Dakota sales tax legislation. So for the sake of the conversation, I'm going to go to a different site up in Toronto, South Dakota, my hometown, also referred to as God's country. There has been another data center that's been announced there, Applied Digital. They have publicly shared that they anticipate to spend $14 to $16 billion on that project, and $4 to $6 billion of that will be for equipment on the inside of it. So about 30% of their budget is for equipment. That's where the sales tax issue comes in. So at 4.2%, I had to do this on my calculator beforehand because I'm not good at math in my head. That's about $200 million. Well, here's the kicker. So how fast AI technology changes, those guys are anticipating needing new equipment every 3 to 7 years. So every 3 to 7 years, it's $200 million that they got to write a check for. So I'm not here to say that the state of South Dakota should do a 0% sales tax, but I am confident that our leaders of this great state will get it figured out so that we can incentivize these data centers in some way, shape, or form. If we do not figure that out, these users will likely go elsewhere. And speaking of that, I know we've heard mostly about 1 or 2 sites over the last year, but I'm aware of about 5 additional sites that are either under contract or soon to be under contract. If the state does get the legislation or some sort of incentive figured out, be prepared for additional announcements coming soon. And then lastly, on data centers, last year we talked about power. These guys need a lot of power. Last year we presented that they needed about 50 to 300 megawatts of power per site. Now, just for perspective, that's more power than the city of Sioux Falls uses for one data center site. Well, now we're hearing more and more that they're looking for 1 gigawatt sites. That's 1,000 megawatts is what they're looking for. The reality is utility providers just don't have that much power, not even close. They struggle to even do 50 to 300, certainly don't have a gigawatt. And so what they're having to do is partner with power generation companies, and that's a good thing. We're seeing more power generation companies looking for land sites, unimproved land sites in our market, and I think that's going to be a good thing to help ease the load on our power grid.
But how does AI and data centers, how does this all relate back to commercial real estate? Well, a lot of experts are saying that we're entering the 5th industrial revolution. Starting back in 1780 with the harnessing of steam power, it transformed our economy for 120 years. Then the invention of electricity and the use of assembly lines, again transforming our day-to-day lives for the next 70. Then we had computers. Then we had internet. And now we're sitting here at the infancy of AI. Now, just to put that into perspective, let's go back to the infancy of the internet. Who remembers this?
You've got mail.
How about this one?
Yahoo!
I'm glad you guys recognized it. I had to ask Uncle Rob here to explain it to me. But in all seriousness, if we were to put ourselves back in this era and try to predict how the internet was going to change our lives, of how we work, how we shop, how we make things, I don't know about you, but I think I would have been off the mark using these. And the reality is the apps we have right now, the Groks, the ChatGPTs, they're the AOLs and the Yahoos of their generation, right? So I'm not up to here to tell you how it's going to change. I just know I'm pretty confident that it is going to change. How we work, how we shop, and how we make things. And so we're going to definitely keep a watch on this and make sure we understand how it impacts our audience and how it impacts commercial needs. That wraps up that conversation. Let's head back to the Sioux Falls Metro and end with improved land transactions.
Well, on the improved land side, we're going to continue to look at Sioux Falls, Harrisburg, T, and Brandon. So improved land is when a developer's purchased it, they've put some infrastructure into it, all the utilities, they've put the streets in, the curb and gutter, they've graded it, they've paid the platting fees, and they're going to deliver a build-ready site to an end user. So that's the improved land. Let's see how we did last year in 25. So in 25, we had $82 million in total volume over 75 transactions, a pretty solid year. And really the last 5 years, we've maintained a pretty steady growth there. So it's been a really positive last 5 years for us. Braden's going to break this down in per land type use.
As we break it down the different assets, we'll start with office. Good year in office. We had a total of 10 transactions, very similar year to last year. Some signs of health in the office market, particularly these smaller land users. On the other hand, multifamily, we only saw 4 transactions last year, a sign of some softening in that market. Retail continues to be a strong performer in our market, 36 transactions. A positive thing to see is those national brands venturing out into our neighboring communities. Bobby will touch a little bit more on that in her presentation. And then lastly, industrial. Industrial had a good year, just not at the way top, not bad, just a good solid year. Let's take a look at pricing. Again, retail office had good years. Pricing is up, kind of on a historic trend line, which is a good sign for those two markets. Again, on the other hand, another sign of softening in the multifamily. It's the lowest average of the last 3 years. And then industrial, really the pricing has plateaued. With the run-up in industrial pricings the last few years, it's probably a good sign that it's kind of plateauing just right there. Let's wrap this up with some predictions.
So we're going to bounce back to the data center side of it. My prediction is that the state of South Dakota leaders are going to figure out some sort of incentive to get these data center sites here. Again, we're kind of getting left in the dust by the neighboring states. We're a competitive group of people, probably everybody in this room too. I do think we will get this figured out here in 2026. And because of that, I'm going to predict that we'll have at least 3 additional AI data center sites that get announced this year. And when I say AI data center sites, most of them are about 300 plus acre sites. I know there was a Rapid City announcement here a week or two ago about a 20-acre site. I'm not talking about those. We're talking about the large 300-acre sites. I think we'll see another 3 of those announced, assuming our leaders get that figured out. On the bulk land side of things, the unimproved land, again, think farmland, I'm going to predict that we'll have about 800 acres sold in 26. That's down a little bit from 25. And the thinking on that is that there's a pretty decent amount of inventory that's out there right now. I think these developers want to see a little bit of that inventory get chewed up before they go look to make another purchase. So I think 26 we come down a little bit, but be prepared for 27 to be back on the rise.
On the improved land side, I know I'm making some very bold predictions here, but I honestly think it's going to be a very similar year to this year. Office and retail, I think, are still solid and can continue to have good years. Industrial, I think it's going to continue to have a good year like it did, kind of an average year. Now, I might sound like a broken record as every year I voice my concern about the supply of industrial ground, especially 200 acres just getting announced out in Foundation Park. And so if that supply is limited, it might hold us back a little bit in those transactions, but every year industrial users find opportunities and make the transactions happen. So I'm keeping it right there. And then lastly, multifamily, I think we'll have a down year again, like we did this previous year, with developers concentrating on their current portfolios rather than looking to add to it. So that concludes our presentation. We'd like to bring up Bobby to present on the retail market. Thank you.
Thanks, guys. Is anybody else having a really tough time getting the Yahoo out of their head? It's very distracting. As Braden said, I'm Bobby Tibbetts, and I'm going to present today on the retail market. Stabilized by growth, supported by population, and protected by the metro. Our Sioux Falls retail market is operating right now in the Goldilocks state. What I mean by that is it's not too tight. Our tenants still have options. And it's not too loose. Our landlords aren't deeply distressed. What's notable here is that in the last 5 years, we've brought on significant amounts of inventory, yet our vacancy rates have not spiked. Now, the danger in any balanced market is pressure buildup, right? Rents climbing too fast, tenants deciding not to expand, developers overshooting, and space becoming scarce. Let's dig into this a little bit further. Sioux Falls did not slowly grow its retail base. It absorbed the demand first, and then it accelerated. In the last 5 years, Sioux Falls has brought on nearly 1 million square foot of retail inventory, yet our vacancy rates dropped from 13.3% to 8%, and year over year, we're down a percentage point. That alone tells us the story isn't oversupply, it's absorption. With that, our growth has been very intentional. If you look downtown to areas like the Steel District in Sharapa, we needed that retail space, and it added thousands of square feet. Looking outward to the suburban markets, we added retail neighborhood strip centers at areas like 69th and Cliff, 26th and Veterans, and 41st and Ellis. Again, the headline here is stabilization, not distress. Unlike the national trend, where limited new supply is forcing tenants into second-gen spaces, Sioux Falls is continuing to grow and doing so in prime locations. And importantly, this space is being delivered with tenants in tow. In keeping with this 5-year look back, let's go ahead and look at the vacancy rate changes from 2020 to 2025. Now, there's a lot going on with this slide, so I'm going to point out 2 key areas. Lake Lorraine in 2020 had a vacancy rate of 30.3%, and in 2025, we were at 5%. The mall area was at 8.1%, and in 2025, we were at 2.2%. Both of these are better or in line than the national shopping center vacancy of 5.7%. And in looking at all of this, each area is down but 2. Again, this shows us that the foundation is solid and the demand is real. Now, don't get me wrong, we have seen closures in our market, especially in the areas of boutiques, breweries, and even Starbucks. Starbucks, for example, is more of an operational or a strategic decision and not as much an indication of market failure. Starbucks is still paying rent locally and optimizing nationally. I believe the real story here is growth and expansion. Looking at the national tenants, we've had expansions with Lululemon, we've had multiple sites, Chick-fil-A added another, Culver's, Taco John's, Simon's Tacos. Many of these, Lulu is a perfect example of a proof point. They started in the mall as a temporary space, they signed a long-term lease, and then they actually expanded significantly in 2025. I do want to make a quick note, contrary to the idea of expansion, we are seeing the retailers prefer smaller footprints, so those compact, optimized layouts are starting to gain traction. So keep your eye on this trend to continue. The sum of this slide is the signal of growth. Rents reflect strength. Looking at this slide is another 5-year comparison, and this shows this perfectly. Class A, high traffic strip centers rose in almost every single area. 41st Street went from 2020 at 25 a square foot to 36 a square foot. South Minnesota Avenue, which we're talking the 85th area, went from 28 a square foot to 32 a square foot in 2025. And West Sioux Falls went from 20 a square foot to 23 a square foot in 2025. One of the clearest indicators of market strength is not just activity, it's pricing. In 2025, we recorded 42 retail sales. That matches a record high from 2020, just 5 years ago. But the difference from 2020 is roughly $20 million of value. So the difference isn't more deals, it's more value per deal. That's largely a product of rising rents, right? Higher rents mean higher net operating income, which supports higher valuation, even with cap rates remaining competitive. In simple terms, buyers are paying more for retail real estate because the income justifies it, even with higher interest rates. And honestly, construction's expensive. So both investors and owner occupants are looking to existing. The metro effect. This is where the metro communities complete that Goldilocks story. Brandon, T, and Harrisburg function as pressure release valves. So when Sioux Falls begins to tighten and rents start to rise, national brands want to plant their flags nearby. This is a perfect example that retail here isn't discretionary, it's population serving. Even with the state sales tax revenue down 0.6%, Sioux Falls increased by 2.4%. And looking at the metro markets, Brandon was 5.81%, Harrisburg 4.92%, and T was 2.58%. This aligns perfectly with what we're seeing on the ground. Strong population expansion, retail absorption, and new commercial offerings coming online. And that's why Sioux Falls stayed just right. Sioux Falls isn't avoiding growth, we're managing it. And this is why Sioux Falls stayed resilient and in that Goldilocks zone, or in the case of this slide, in the expansion phase of the real estate cycle. In wrapping up here, I'm gonna give my predictions. I'm gonna do my personal best to make sure that the local retail economy stays strong. But if somebody can tell my banker husband, who is in the audience, that this is for the greater good and not for my retail therapy, that would be great. With that said, truly I'm bullish on the Sioux Falls retail market. All of the same fundamentals are in place. I believe that our vacancy is gonna go down because I believe that second-gen spaces and new construction is gonna continue to get absorbed. I think that our construction is going up. Watch downtown with areas like rail yard development, out northwest with Boyce Park, south with T-Commerce, and the 85th interchange. I don't think 85th you'll see buildings go vertical, but watch for land grabs there. And with all of that activity, I believe that we'll have 3 new QSRs announced here in 2026. With that, with stable occupancy and strong rents supporting high values, I believe that we are gonna have a record year in sales in the retail market in 2026. With that, I'd like to bring up Andy Anderson and Isaac Jorgensen.
Great job.
Hi, my name is Andy Anderson.
And I'm Ron Burgundy. No, just kidding. I'm Isaac Jorgensen.
And we are going to be presenting on the office market this afternoon. After several years of disruption, the office market is finally moving from confusion to confidence. Even though we continue to see hybrid work and excess blocks of large square footage, those continue to be headwinds. However, vacancy rates are improving and buyer interest is very strong, which is really encouraging. And we are seeing tenants and landlords both moving from reactive decision-making to real strategic planning.
That's right, Andy. Now more than ever, tenants are being very strategic and deliberate with their space choices. Is there a weird reverb that you guys are hearing when I talk? Just in my head, typical. No, tenants are asking themselves, what does our current attendance look like? Moving forward, do we require more pleats in the seats? What do we actually need in an office space? And how do we get that on the most efficient square footage as possible? They're planning for long-term affordability and functionality while considering things like increasing triple net expenses that are weighing heavy on tenant negotiations.
And the basic fundamentals are certainly improving in the office market. However, there is one other factor we wanted to point out, and that is commercial mortgage-backed securities special servicing rates. Now, these are typically very large loans and represent about 10 to 15% of loans nationally. However, it brings really good insight as to what borrowers are feeling right now. And special servicing rates represent loans that are in distress. And the CMBS office special servicing rate is the highest we've seen, currently sitting at 17.3%. This is something to just keep our eye on and pay attention to throughout 2026. Now let's shift gears and take a look at the local Sioux Falls office market.
As a local kid growing up in Sioux Falls, I was not sure we had billions of anything except maybe corn cobs or potholes. That could have been just because my mom hit every single one of them. Dad, don't tell Mom I said that. But so I bring that up because it amazes me whenever I'm reminded that we have 18 million square feet of office space in Sioux Falls. It feels like a lot of space. Of that 18 million, 8.2 is owner occupied. Going forward, we will not factor that into our vacancy rates or our rental rates, but instead, Andy and I will focus on the 9.7 million square feet of tenant inventory. Of the 9.7, we currently have 8.5 million that's occupied and 1.2 million available for tenant consideration.
And we're going to touch on that a little later in the presentation as well. Now, although Sioux Falls is not immune to office market challenges, our vacancy rate here in Sioux Falls continues to remain well below the national vacancy rate, currently sitting at 12.1%. Now, what that means is greater market stability, healthier demand, and significantly lower distress risk than we're seeing at the national level.
Yeah, let's break that 12.1% down into our two sectors, downtown and suburban. We had a big announcement for downtown, but it got ruined earlier this week, so thanks, Mayor Paul. But no, congratulations on that. But our downtown remains incredibly healthy. It's kind of leaning towards a bodybuilder a couple days before a show, getting a little too lean for anybody's comfort. At the end of 2025, it was sitting at 4.1%, with just over 110,000 square feet available for lease. The delta between Class A and Class C continues to spread downtown, with Class A topping out at $34 a square foot and Class C hovering in that $12 a square foot range. This spectrum of rates, though, gives options for tenants with various budgets to find a home in our thriving downtown. As we shift to suburban, it's a little different story. Suburban, quick note, is anything outside of downtown, north, south, east, west, anything in Sioux Falls that's not downtown. At the end of 25, it had 3 times the vacancy rate of downtown, with a 15.2% rate and over 1 million square feet available for tenants. As we dug deeper into that 1 million square feet, though, we found a discrepancy in demand, and it really depended on the size of the suite that was available. Andy will expand on that in a couple slides.
Now let's take a look at the Sioux Falls office sales in 2025. We had a total of 34 transactions, which represented $67 million in sales volume. Now, we had a wide range of per square foot sales in 2025, ranging from $40 a square foot all the way up to $400 a square foot. So that really did skew our average per square foot number. But we're looking forward to a strong 2026 in office sales.
Yeah, let's jump through a couple of those sales from 2025 and highlight them quick. This time of day, there's been a lot of caffeine already taken in, so if I talk quick, bear with me and check out the screen. First one is 4409 South Technology Drive, located just northwest of 57th and Louise. This former call center building was purchased by Collision, a nonprofit that serves our community and is a great example of a call center transition and the ability for the new owner to occupy a building in a great location in our market without breaking their bank. Next up is 116 West 69th Street, located just west of Looks Marketplace. Little different story here, sold last year for about $261 a square foot to an owner-occupant investor because there was a market rate tenant with some turn left on the top floor. So urology specialists could put their business in the lower level and grow their equity and grow their business in one of the most sought after areas in our community. Next up, 3500 South Sheldon. Excuse me. This was another owner-occupant investor sale in 25, with Falls Dental purchasing this directly from their landlord for about $200 a square foot. Multiple tenants, no current vacancies, the right size suites. This will prove to be another wise business decision. And last but not least, I think this is Andy's favorite sale of last year, 2500 East 52nd Street North, located just off 229 in Benson. This 44,000 square foot building with plenty of land, great flexibility for future uses, is going to be the home for Game Day Social, a thriving Sioux Falls business. They bought it for less than $100 a square foot, and that price allows them to reinvest and reimagine this building as they continue to grow and thrive. Another great example of large block space being absorbed and repurposed in our market.
And we just wanted to touch on one other building that sold. The U.S. Bank building has been in play for several years and recently sold for $49 a square foot. This is going to be a really exciting transition for the downtown market. U.S. Bank is going to continue to occupy the 2 main levels, and then with a new hotel being constructed over the next few years, I think it'll just be a very exciting addition to downtown. Now let's reflect back on that overall inventory slide and the 1.2 million square feet that's currently vacant. Of that, over 260,000 square feet sits in blocks of space 10,000 square foot or lower. 900,000 square feet sits in blocks greater than 10,000 square feet. Now, if we were to pull that square footage out of our survey, our vacancy rate would drop from 12.1% down to 2.7%.
Boof. That is too lean. It's like a bodybuilder needs some carbs.
So now let's head to the real estate cycle.
Sorry, I know we're the midpoint. We're trying to keep you guys awake a little bit here. Office can be exciting too, I promise. Real estate cycle. So this is driven by a strong demand for spaces less than 10,000 square feet, lack of inventory to honestly meet that demand, and a thriving downtown. We feel we are firmly in expansion going into 2026.
And call center's been sitting in recession for several years. So I really do think with the strong buyer interest that we're seeing toward the end of 2025 and into 2026, this will definitely be the year for call center space. And now let's move on to our predictions.
Yeah, our final slide here. Our initial prediction is that vacancy rates will fall, specifically in the suburban sector, and that's because we are seeing a strong buyer demand that Andy just mentioned in some of these remaining large block spaces. Triple net expenses, operating expenses will continue to climb, and this will weigh heavily on tenants and landlords as they negotiate space, negotiate leases, and decide what to do with their real estate in 2026. And last but not least, we feel that there will be, for the first time since 2021, there will be more than 40 office sale transactions. And that's driven by a very strong owner-occupant pool and some new product that we know is coming on the horizon.
And with that, Isaac and I would like to bring up Rob Fagnan to talk about the industrial market.
Yeah, nice work, you two. Well, I almost didn't come out here because the women's USA hockey game was on. I was watching that in the back. Thank God they finished it out and won gold. So, yeah, I was hoping to save you guys a little bit of time, but now you got to listen to me. Well, by now, most of you have probably heard about the big news earlier this week on Monday, and I just want to take a minute to call out and just say thanks to Bob Munt and his team at the Sioux Falls Development Foundation, the mayor and his team at the city, and the governor and his team at the GOED. It's not often that you get to see a group like this collectively work together and accomplish what they did. And so I just want to say thank you. And I'm sure there's a lot of people in this audience right now that are overly excited about the potential of the next decade, 20 years, 30 years, 40 years down the road, downtown. And I might be the black sheep in this room, but I'm a heck of a lot more excited about the investment and growth that's taking place within industry in this town and in our region. And so that's what I'm presenting on today. And we're going to start by where things wrapped up in 2025. Okay, nationally, things weren't looking so good by the end of 2025. Vacancy shot up to an over 10-year high. Net absorption was the lowest since 2010. And new construction dropped to its lowest level since 2017, resulting in a 1.1% decrease in rents year over year. Now, for 2026, I think that it's going to be a rebound year nationally with some of the construction pipeline slowing and a lot of the occupiers out in the market across the country right now absorbing some of that oversupply of space that's out in the market. As far as the Midwest, how are we doing? Well, there was a slight uptick in vacancy, but look at that. Net absorption increased by 73%. And that's due in large part to all the leasing activity that took place towards the end of the year in Q3 and Q4, and then a pullback in construction. So rent stayed stable in the Midwest. How'd Sioux Falls do? 4.8%. Net absorption pulled back, while construction continued to remain strong. This is going the opposite direction of we don't want to see that gap widening in our market. And as a result, we saw a slight decrease in the average asking rents in our market. And I'll dig into this just a little bit more here in a little bit. But I want to start off by taking kind of a 60,000 foot view of our industrial universe. In other words, the total square feet that makes up our market. And you can see in 2025, we saw a 4.3% increase in the overall industrial market, topping us out at about 34 million square feet. Now, what made up that increase? Well, CJ Foods finally, after several years of waiting, broke ground, went vertical on their new 700,000 square foot state-of-the-art food manufacturing facility. And Amazon is well underway in their last mile distribution facility, 125,000 square feet. They're moving from a 60,000 square foot spot up on 60th Street North and virtually doubling their size. And then Silencer Central. They're growing so fast that they put up a 55,000 square foot warehouse up on their campus, which is also along 60th Street North. Now, I wanted to highlight just a couple spec projects. We're still seeing spec construction in our town, although not quite to the extent that we've seen in recent years. But there was an Omaha investor, who came to town a few years ago and bought some land and finally decided to go vertical on two 20,000 square foot buildings up in Sioux Empire Development Park 8 East. And then there's an investor who's built a few buildings out in the Corson Brandon Park that put up a flex building out there, about 34,000 square feet. So this made up a good chunk of the new construction we saw in our market this past year. But how did it fare overall? Well, you can see here in 2025, we were just over 1.1 million square feet, topping out at our 10-year average. So how did absorption do? Saw about a 20% drop to 680,000 square feet. And it's no wonder why we see vacancy continue to rise, because that supply-demand gap is widening. This is the highest our vacancy has ever been in 20 plus years. Now, when I was given this presentation in front of my family at home, you can imagine when I started talking about the national vacancy being 6.7%, what my kids were saying about that. They said 6.7, started laughing, and I had to kind of bring it back down to earth and just tell them, educate them on how important it is to understand and know that the vacancy is 6.7% on a national level. It's important to know that. All right, switching gears and taking a look at the health of industrial sales in our market. We had a whopping $160 million spent on industrial property this past year, most we've ever seen. We did see a slight pullback in total transactions into the mid-50s, but the moral of the story here is there were some very big industrial transactions this past year, and Nick's going to highlight that in one of them in his presentation here in just a bit. Now, I added this slide a year ago. I wanted to take those 54 transactions and break them down into what are things selling for on a price per square foot. And you can see in 2025, the bulk of transactions are taking place in that $76 to $125 a square foot range. Now, what's interesting is we continue to see transactions in that 126 to 175 range, which is essentially what it costs to build brand new these days. And so I think because we continue to see inflation, the inflationary cost of construction improve or continue to go up, along with the demand that we continue to see in our market, I think we'll continue to see stabilization and be within those ranges here throughout the remainder of the year. All right, let's pivot and take a look at lease rates. So Class B, Class C trade in a tighter price per square foot range than that in Class A. Class A is kind of a hot mess. It's all over the board. And that's primarily due to it having a diverse set of factors that kind of drive that market. Cost of construction is one thing. The other thing would be flex type spaces where it's maybe not just a warehouse type use, but it has a retail component to it. Sometimes that derives typically a higher price per square foot when you're renting the space out. And then contractor shops. You go out and you try to build a 10,000 square foot building and lease to 2,000, 3,000, 4,000 square foot tenants. Today, you can't go do that and make $7 to $8 a square foot rent work. And so we typically see $10 to $12 a square foot with some of those smaller spaces. Okay, that brings me to my real estate cycle. We have been in this perpetual stage of expansion for quite some time, going all the way back to 2009. And for 2025, we hopped over into that hyper supply column. And I know 4.8% seems like not that high of a vacancy rate, but again, it's the highest that we've seen in our market in over 20 years. And so we've got vacancy rates increasing. We had high construction, but low absorption or lower absorption. Reggie talked about moderate employment growth, and rental rates have just remained stable these past couple of years. So that brings me to my predictions. New construction. I think we'll see a slight pullback in new construction this year. Obviously, in 2027, we know we can already add to the board a little over 1 million square feet in one project. But with absorption down, I think we'll start to see some backfilling of that oversupply of space that we're seeing in the market. As a result, we'll start to see vacancy rates turn back down. Lease rates and sale prices, we've just had such strong demand in our market over these last several years, even with vacancy being high. And I think lease rates and the price per square foot that people are paying will remain stable. And then I think sales transactions will pick up. We'll probably see somewhere in the 60s, maybe even getting back up into the 70s throughout the remainder of the year. So with that concludes my presentation. I'm going to bring up Alex Soundy to present on the multifamily market.
All right, thanks, Rob. As Rob said, my name is Alex Soundy, and I'll be presenting on the multifamily market today. Let's get into it. We're going to start by taking a look at the national market, starting with multifamily sales volume. In 2026, we saw $165 billion in multifamily sales, up roughly 13% from the $146 billion in 24, excuse me. Not quite the robust years we saw in 2021 and 2022, but continuing to trend in the right direction for what I believe will be a strong year for multifamily sales going into 26. So why is that? What's going to drive multifamily sales in 26? Well, first off, supply has finally reset. In 26, there's projected to be 270,000 new multifamily units delivered nationally, which sounds like a big number, but it's actually the lowest number in the last decade, down 30% year over year from last year. In addition, permitting's down, and new constructions are also down at historic lows. This is a positive thing for existing multifamily assets. This allows leasing velocity to increase, it allows vacancy to pull back, and concessions to burn off. All positive things for multifamily investors. Bottom line, supply is no longer the headwinds that it once was in 2023 and 2024. This graph shows the monthly difference between the average rent in America versus the average 30-year mortgage based on the median priced home. Ending 2025, that difference was $750 a month. That's not including escrow payments for property taxes and insurance, which would actually widen that gap. Basically, home ownership is becoming less and less affordable, especially for first-time home buyers. In fact, in 2020, the average age of the first-time home buyer, 33 years old. Fast forward to today, 40. Bottom line, for investors, this is a positive sign. This signals that there's going to be a constant demand for multifamily housing moving forward. Pretend and extend is nearing the end. Now, this isn't me just trying to imitate Dr. Seuss, but this is a sad reality for a lot of investors. Many lenders over the last 12 to 18 months have been dealing with distressed borrowers, whether that's distress from buying an asset in 2021 at a sub 4% mortgage, staring down a refinance in the current lending environment that's not favorable, or a new multifamily developer that's going through a slower lease up than they originally anticipated, or is not hitting their projected rent pro formas, having them fall outside their loan covenants. Rather than forcing sales or foreclosing on properties, many lenders attempted to work with borrowers. Moving into 2026, those borrowers are going to be forced to make tough decisions, which should lead to more multifamily sales in 26. Capital is back. Both Freddie Mac and Fannie Mae have extended their lending limits by $88 billion each in 26, which is a 20% increase from 2025. Interest rates are trending in the right direction. Now, we're not at the same lows that we were at in 2021, but we have creeped down enough to where deals that didn't quite pencil 12 to 24 months ago are starting to make sense now. Now, I need to be careful when I say this, but the bid-ask gap is tightening. Try saying that 5 times fast. What I mean here is the asking rates for multifamily, from what lenders or from what investors are looking for when they're selling, are starting to creep back down into more realistic price ranges. And buyers are willing and able to be a little more aggressive with slightly more favorable lending environment that we had 12 and 24 months ago. So deals that didn't pencil are starting to pencil again. Investors in commercial real estate are bullish on multifamily. Some reports show that as much as 60% of dry powder set aside for commercial real estate investing is earmarked for multifamily. Let's shift over to the local market. We're going to start by looking at multifamily permits in Sioux Falls. In 2025, we saw 1,168 multifamily permits, down slightly from the 1,224 we saw in 2024. Now, when I made my predictions last year, I actually predicted there'd be less than 1,200 multifamily units permitted in 25. Now, I don't have a crystal ball, but I looked at the fundamentals. We had double-digit vacancy, interest rates were still relatively elevated, and construction cost was high. Not a great recipe for multifamily construction. Looking forward into 2026, I'll touch on where I think we'll be for permitting in my predictions. Let's look at vacancy rates. Now, one thing I like to note before I start this slide is there's a lot of different data sets when looking at vacancy. I chose to utilize CoStar as they own apartments.com, and I believe they're the most robust, reliable data set. Start by looking at the national rate of 8.6% in gold. You'll then see 2 vacancy rates for Sioux Falls. First being the stabilized vacancy rate at 9.3%. This is taking all existing apartments that is excluding new construction going through their lease up. Second is the actual vacancy rate at 11.4%. This includes all those new projects that are going through that initial lease up. This is the true vacancy rate in our market. Now, if you look at 2022, you'll see we have, on the back half, we jumped into that double-digit vacancy rate here in Sioux Falls. Comes as no surprise. We had record permits in 2021, 2022, and 2023. All those units were absorbed into our market. That's a lot of new deliveries into the market that we had to absorb in. naturally inflating that vacancy rate. With the last 2 years of relatively lower permits, I do anticipate vacancy to creep back into the single digits, where we can recover a little more. Now let's look at the effective market rent in Sioux Falls. This shows the average rent per month on a price per square foot basis. When we're talking about effective rent, we're talking about the true net rent. So this is factoring in any leasing concessions. So if property managers are offering 1 or 2 free months rent with a 12-month lease, this nets that out. So you see the large increase from 2021 to 2022, and then we've remained relatively stagnant since. Well, if I were to overlay the vacancy rate we just looked at here, it'd make a lot of sense. Property managers and investors were looking at the high double-digit vacancy rates and doing everything they could to stay ahead of it. Bottom line, they wanted to stay full. They were offering leasing concessions, discounting rates, anything they could do. Anyone that owns multifamily real estate knows that the biggest thing that hurts your financials is carrying a high vacancy rate. So how does Sioux Falls compare regionally? Here we're looking at Rapid City, Lincoln, Rochester, Des Moines, and the Fargo market. Every market had a downward trend in vacancy with the exception of Lincoln, which trended slightly upward from 7 to 7.8%. Obviously the 2 outliers here being the 2 South Dakota cities, Rapid City and Sioux Falls, both in the double digits. Although both trending in the right direction, especially Rapid City going from 16.4% down to 12.7%. I do want to note that I am still very much bullish on the Sioux Falls and Rapid City markets. I don't view this as a sign of a struggling market. We just delivered a lot of new units into growing cities that we had to get through and absorb. Very bullish long term, and I do look for both of these rates to continue to trend down significantly the next few years. Quickly note the average rent in each one of these markets did go up slightly, ranging from just under 1% to 3% across all regions. Let's take a look at multifamily sales. So in 2025, we had 28 sales transactions for just over $150 million in total sales volume, which puts us just under the record year we had in 2022, which was $152 million. One interesting thing to note, we had 19 less sales transactions in 2025 than we did in 2022 for nearly the same sales volume. Bottom line, deals are just getting bigger in our market. In fact, 5 of those sales transactions last year accounted for 70% of the total sales volume at $104 million. Let's take a look at a few comps here. Huntington Village, this is on the east side of Sioux Falls, just east of Veterans Parkway off of 41st Street. Sold for just under $31 million this past April at a staggering $171,000 per unit. Now, interesting piece here, the buyer was able to assume some low interest rate HUD financing on this deal that allowed them to pay more than the market would have delivered. This is a great example of a seller utilizing some favorable financing terms they negotiated to drive a higher price for their asset. Great deal on the seller's part here. Cleveland Park Townhomes. This is a townhome project located off 26th in Cleveland. 126 units sold for just over $13.3 million last year at $106,000 per unit. Another example of creative financing here, the seller was able to carry back some low interest financing for the buyer, allowing the buyer to pay more than the market would have arrived at. Once again, great opportunity for the seller here. Williamsburg Townhomes. This is a LIHTC Section 42 property in northwest Sioux Falls, traded for just over $8.8 million. For 110 units, that's just over $80,000 a unit. West Briar Commons, located on the west side of Sioux Falls, 152 units traded for $24 million this past September, just under $158,000 a unit. And lastly, Three Falls Apartments. This is located off 6th Street just west of Washington High School. This asset traded for just under $5.6 million at year end for roughly $93,000 a unit. So where does that put us in the real estate cycle ending 2025? Well, with low new construction, moderate absorption, and low rental rate growth, I have us at the tail end of recovery. But going into 2026, I do expect us to jump over into expansion as I predict that vacancy rates will pull back and we'll have some moderate rental rate growth. Let's look at my predictions. I do predict that we'll have less than 1,200 multifamily units permitted once again in 2026. Same fundamental challenges apply here. Construction costs are still high, interest rates are still relatively high, and vacancy is still in that double digits. Developers are sitting back waiting for more favorable environments before they get in the ground. One thing that could change this is with the announcement of the new opportunity zones in July. Depending on where those land, that could incentivize some developers to pull the trigger and move forward on some projects. But I do anticipate that'll more so have an effect on 27's permitting numbers rather than 26. As I said a few times in this presentation, I do think vacancy rates are going to continue to trend down with the lower amount of units being delivered into our market. And with that, it will allow rental rates to pull back up and have a good year in 2026. And lastly, I think we'll have a record year for multifamily sales in our market here. This could be the first year that we break $200 million in total sales. And with that, I'd like to invite Nick on stage to talk about capital markets.
Thanks, Alex. We're going to wrap up today's market outlook with capital markets. We're going to focus on a couple of big trends that will allow us to make a very bullish prediction at the end of the presentation. When we talk about real estate investing, it's really important to note our clients have a lot of options when it comes to allocating capital. They can buy commodities, stocks, bonds, even a rookie Tom Brady card. When we look at some of these returns in 2025, some of them look pretty great. Look at silver, 153% return, 1 year hold, 2025. Why would we even consider investing in some boring real estate with returns like that? Let's take a look. The answer is quite simply that real estate is a major storehold and vehicle of the world's wealth. Here's a couple of very wealthy countries here on the globe, starting with the United States. 30% of the United States' wealth is in real estate net of mortgages. I'll repeat that, real estate net of mortgages. In the United States, it's followed by insurance, pensions, securities, other financial instruments, and some cash. Australia, if you go all the way down, 53% of Australia's wealth is tied up in real estate net of mortgages. So real estate is a really big deal. Let's check in on global real estate investment. Now, this chart shows transaction volume in dollars, US dollars, and it starts in 2016. The couple of things I want to point your attention to, there were massive years in 21 and 22 that was high liquidity with stimulus, with very low interest rates, and transactions really pulled back in 23. The reason was very simple. Real estate became very expensive to borrow money and acquire. We're going to take a look at that in just a little bit. Let's take a look at the U.S. commercial real estate investment. Very similar chart, and it's worth noting that globally, the U.S. investment real estate market makes up 50% of total transactions measured in dollars. Same story, 21, 22 big years, a big pullback in 23, and I'm happy to report the last 2 years have been in solid recovery. This is good news. Okay, let's talk a little bit about national cap rates. When you hang around real estate investors, you hear the word cap rate or the term cap rate be thrown around quite a bit. And what's that stand for? It's a capitalization rate, and it's basically the yield of a property over a given year if you bought the property in cash. So it's really just a yield measurement. And this goes all the way back to 2022 with a couple of asset classes, office, retail, multifamily. And the good news, cap rates have come up and have really remained stable over the last 2 years. This is also very good news. We talked a little bit about how transaction volume globally and nationally kind of pulled back in 23, and that was due to the cost of debt. This is a bank prime loan rate going all the way back to the year 2000, okay? So if you take a look on the far right, in the summer of 2024, it was the most expensive time to finance debt. It was the most expensive going back a quarter century, all the way to the dot-com bust. So that makes a lot of sense how, real estate transactions pulled back. The good news is you can clearly see, those rates are coming down. Let's bring it home to Sioux Falls. This is change in sales volume in dollars year over year. And this is 23, 24, and 25. At the very top is U.S. investment sales volume. That's all the real estate transactions, investment real estate transactions in the U.S. 23, big pullback. 24, some recovery. But it's clear to see in 25, the national market's clearly recovering, but Sioux Falls is outpacing that national recovery. So it's a really good time to be in Sioux Falls. We'll touch quickly on some Sioux Falls cap rates ranges. In office, it's about 6.25% to 8%. In retail, 6 to about 7.5%. And industrial, 6 to 7.25%. We're going to touch briefly on 3 institutional-sized transactions that happened in Sioux Falls in 25. First one was the Owens and Minor building. This is a very large industrial facility that's leased, long-term lease, $64 million, 7% cap rate. MacArthur Square, really nice mixed-use project, office on retail main level. This is south side of Sioux Falls with apartments on the second and third story. $10 million transactions, almost 11, 8.2% cap rate. ABS Colors portfolio, this was a collection of industrial properties leased to one company. The largest property was here in Sioux Falls. The others were kind of scattered in smaller communities across South Dakota. There was one location in Mankato. This was over a $10 million transaction, 7.1% cap rate. Okay, here are the big 3 things that is going to affect everyone in this auditorium this afternoon. First big thing, there's a massive amount of capital sitting in United States money markets waiting to invest. We'll take a look at the details in just a moment. Second thing, there's a generational real estate asset and capital transfer in process right now. When I looked at the demographics, it surprised me, and I'm fairly familiar with this, so looking forward to showing that to you. And the next, we have a strange 3-year window of investor certainty despite our political strife that we see on our headlines every day. Let's take a deeper dive. This is U.S. money markets in trillions of dollars. When I started brokering 22 years ago, there was roughly $2 trillion sitting in U.S. money markets. If you go all the way to the far right-hand side, we're sitting as a country on about $8 trillion of cash in a money market. That's incredible. There's a lot of dry powder there. Let's take a look at the next big trend. U.S. generational wealth transfer. There's a lot going on here, so let's break it down. Each gold bar that you see is a generation and how much personal net worth they control. So if you go to the far left, if you're 81 years old or older, your generation controls about $20 trillion worth of personal net worth. The boomers, 62 to 80, are controlling about $80 trillion of personal net worth. Gen X, that's everyone mid-40s to 61, they're controlling about $40 trillion of personal net worth. Everyone else, that's millennials, Gen Z, and younger, they're controlling less than $40 trillion. Okay? So when you think about it, as these age groups age over the next 10 years, there's going to be a massive wealth transferred to the next generation. Silent generation's that wealth's going to move over to the boomers. A lot of wealth in that boomer category is going to move over to Gen X, and Gen X to the millennials. Okay. The next slide, I need to preface by saying we're only talking about investors on this next slide. I've been married for 22 years to a wonderful human who just happens to have a polar opposite political view that I do. Over the last 2 decades, it's been a lot of fun. We've learned a lot. We will sometimes trade phones and look at each other's echo chambers. That's always really amazing. It's a lot of fun. However, over the last year, we've really noticed that the propaganda machines are really, really cranking right now, and there's a lot of political strife. I think neighbors, friends are having difficulty communicating with each other on just very simple topics. So we have that in mind, but let's take a look at some interesting things that are happening for investors. I believe investors will have a 3-year window of certainty. Okay, let's take a look. Federal income tax structures will not change over the next 3 years. Kind of a subtitle under that is every once in a while in an election season, you'll hear about 1031s going away. Anyone remember that? It'd be really painful to lose the ability to 1031. You're going to be able to 1031 at will. Your tax structure, we're not talking state tax structure, but the federal tax structure is not going to change in the next 3 years. Tariffs. Okay, they kind of turned out to be a negotiating tool, not the end of our economy. Interest rates are going to remain neutral, or they might get slightly better. Why is this important? If you own an asset and you've owned it for 30 years and you're trying to figure out how much this asset will sell for in the next year or two, you have a pretty good idea of what it's going to cost the buyer to borrow money to pay the highest dollar for that asset. That is certainty. There's historic levels of cash. We just looked at it. $8 trillion of cash. Yes, the boomers control a lot of that cash. However, I can tell you, just in deals I'm doing right now, millennials are actively raising money and purchasing assets. When we hear the word millennial, sometimes we think of people eating funny toast and wearing silly clothes, right? The reality is that the older millennials are now in their mid-40s. They're losing their hair, they're getting gray, and they're very serious about building their wealth, okay? That leads me to predict we're going to see historic commercial real estate sales transactions in the next 3 years. I believe this will accelerate exponentially after midterms. I think we might see as much as 10 years worth of deals in a 3-year window. With that, I'd like to give it back to Reggie to close us out.
Thanks, Nick. Thank you, Nick. Last year we had one big, beautiful bill. This year we got one big, beautiful Gustafson prediction. How about that? A couple of quick thank yous and one final thought. Number one, thank you to you, the business community, for your trust and your time. We hope that we've provided some value to you. Secondly, to our team, Ellen Jesperson, our Director of Marketing, we could not do this without you. Thank you so much. I actually sent her a slide this morning, and she got it in. Secondly, to our team, to Summer, Sarah, and Lenny as well. Thank you. We couldn't do it without you. Thirdly, a special thank you to my friend, Mayor Paul Tenhaken. You've dealt with floods and ice storms, derechos, tornadoes, COVID, and protests, and you've been a champion through it all. Over the last 8 years, our city has grown by 45,000 people. We've annexed over 5,000 acres, and your building department has approved over $8.5 billion. Thank you. Please join me in thanking Mayor Paul on behalf of myself and the Bender team and the business community. Thank you to Mayor Paul. One final thought. I'm not going to be the man to stand between this crowd and the open bar behind us. Not that long ago, the pundits were telling us that there was a recession coming, that there was no way to land this economy softly. Take a look at the underlying fundamentals. Inflation is softening. The job market is steady but strong. And our GDP is poised for a breakout run. If 2025 was our year of Forrest Gump's box of chocolates, 2026 is Run, Forrest, Run. That's a killer Bender tattoo you got there. We all know that you're going to run the race with us. And we also know that every runner needs a good water bottle. So we've got a Bender Yeti for everybody here. Please join us up on stage now. Thank you. That concludes today's presentation. Thank you.